This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, and this week's guest is Agostino Pintus, the founder and CEO of Bulletproof Cashflow, where he applies nearly 2 decades of real estate experience to source, negotiate, and acquire commercial properties of all sorts. Currently, his portfolio consists of multifamily properties and triple net industrial buildings, and he is also the host of the Bulletproof Cashflow podcast, which highlights successful investors, marketers, and capital raisers of all sorts. Agostino and I did a deep dive on the mindset of the retail investor in today's market, along with his recent pivot to development using various tax-saving strategies to secure the returns that he and his capital partners are looking for as we head into this next recession. So without further ado, please enjoy my wide-ranging conversation with Agostino Pintus. Agostino, welcome to the show.
Hey, man. Thanks for having me on. Greatly appreciate it.
Well, that is for everybody else listening, because we just wanted to let you in on the party, because Agostino and I could have gone on for about 4 hours as we were just chatting about the direction of our show. And so we thought we'd let you in on it. But what I'd like to do right now is I've already shared, Agostino, a little bit about yourself in the bio, in the intro. If you would, why don't you fill in the gaps and then let us know what you're doing right now as this market is pivoting and changing. And I think that's probably where this conversation is going to go from there.
Yeah, absolutely. So quick history. We started our business doing multifamily acquisition, mostly B and C class stuff. And I'm a real big believer of focusing down on one market, building some scale, and then moving on to another market and doing the same thing. I am not a big fan of jumping around different places, buying 100 units here, 100 units there. That's a whole other show we can discuss at some other time. But at any point, we started doing multifamily acquisitions, and we basically pivoted away from that for the time being because the market makes sense. And now we're focusing on development, ground up development and redevelopment of existing historical assets, and single tenant net lease type scenarios too. So think of Dollar General, Dollar Tree, DaVita, Advanced Auto Parts, stuff like that. So those two are our primary focus these days. Not saying we would never do multifamily again. If there's a deal that comes up and it makes financial sense to do the deal, we will do the deal. But like we were talking about in the green room, there's a lot of shifting that's taking place in the overall economy, the overall shift that's taking place in overall society as well. But again, we'll leave that for another show. And it's way more conducive today to be doing development and to be doing net lease as far as where we are today and with the economy and where it makes sense to put money in terms of the financing that's needed to get these deals done.
So that is a song that we're hearing a lot, Agostino, is that, we develop as well. We acquire existing self-storage facilities, value add stuff. It's all about taking a, Class C asset, trying to take it up to a B or higher. But we found that even though we still have a lot of projects in our funnel and coming down the pike, that still the best way to create value is to start with a piece of dirt and then put a building on it and then put an income stream on it, even in today's higher construction costs. And I don't see that coming down much. I mean, price of steel's come down a little bit, but I think most of those prices are here to stay. So when you look across the landscape and your developments and doing even some of the historic stuff, is it primarily what you found, or have you found a niche in the historical side as well that gives you an extra couple basis points in terms of creating value? Tell us how you gravitated towards that edge of approaching this market in development and then historic.
Yeah, absolutely. So development is really to serve a need first, right? There is definitely a need for housing in today's market. It's mostly a national phenomenon. We're finding it in especially when it comes to urban infill, like the bigger cities or cities in general, a lot of need for housing, even today. And we are becoming a renter nation. I think that the days of where our parents would go and buy some nice big home and have a big backyard and pay a mortgage payment and have the 2 cars and all that stuff is just about over, I believe at this point. It doesn't make sense to do that anymore. It doesn't make sense to play that game, to really stay at one job for 30 years and make the mortgage payment. It doesn't make sense to do that. These days, it makes sense to get into an apartment, get into a unit, enjoy some great amenities. You have security. You have a local amenities outside, like the great restaurants and food and all these other great things you can enjoy outside. And then if you want to change your job, you want to move, you want to do whatever, you just put in your notice and you leave. 2 years later, you're out the door, go do it again, right? The price of housing has also gone up as well. So for many young folks, especially, the thought of spending $500,000 on a house just doesn't make sense anymore, So we're filling a need. And the thing is, though, when we're doing our ground up and redevelopments, those typically have some sort of opportunity zone component or historical component or tax abatement component. We're trying to target those types of assets. For instance, I'm here in the Rockefeller building. John D. Rockefeller built this building over 100 years ago, and we're converting it to 436 units. The first floor is going to be retail. The 2 and 3 are going to be office, and the rest of it's going to be multifamily. And there's literally Sherwin-Williams right next door, 100 feet away from me, building the world headquarters, 6,000 jobs right nearby. I'm not worried about this place filling up. It's going to be fine, right? There's going to be a need. And we're doing ground up right near Cleveland Clinic. We're doing ground up near Metro Health. So we're targeting, we're being very smart about what we're putting up. When it comes to the net lease side of the business, is very interesting because these are monthly returns backed by a corporate guarantee. Is Dollar General going out of business tomorrow? Probably not. Advanced Auto Parts going out of business? Nope. As a matter of fact, businesses like that, they thrive when economics situations like what we're experiencing today happen. And not to be a doom and gloom type of guy here, inflation is going to be here for a while. You better hunker down if you haven't already. My opinion is that we're going to see high interest rates for a little bit here. You can't print money into oblivion and expect it to just be fine in a year. I don't see that happening. I just don't see that. So getting that monthly cash flow, putting your money into hard assets that produce cash is where you really need to be these days, my opinion.
Mm-hmm. Yeah, it's interesting times. It's forced us all to kind of take a look under the hood of traditional financing in our own personal finances. We've heard for years, and we've seen with Airbnb coming into play now, and then also some folks that when they downsize, they decided to rent for a while or buy an RV or Airbnb around the country, and then they recognize and realize that housing, the house, to your point, I guess, it used to be, the best investment, you could ever have, back in our parents' day. But the savvy investor recognizes, man, so I'm really only making, whatever the interest rate is, 6% or so. And I got some appreciation on the house, that's one thing, but I got all the maintenance, everything else that goes along with it. And the lost opportunity cost of having that cash or my equity tied up, which I could have invested somewhere else if I were a better investor. And so people are wising up to that right now. And then also looking at housing as an expense. And especially if you're looking to move up into a nicer home, a larger home, there is that ceiling as to how much a landlord can charge in rent versus the value before he prices himself out of the market. So a friend of mine who's a very astute real estate investor that lost it all in 2008 when all his notes were called due, nothing to his doing. He's still a great investor, always was a great investor. And he lost his personal residence as well, which is a very, very nice home. Well, he rented across on the other side of the lake with a better view, a bigger home. And his rental payment was less. And he said, you know what, you see that terracotta clay tile roof up there? He said, I don't have to spend $50,000 when the one on this house goes out like it did over there. And you begin to look at the actual, living as just an expense. And I think people are starting to change the ways. We are becoming a renter nation. One other piece to add to that as well, you probably have seen this, but there's these guys and gals that are going out and they're buying the apartments on a cruise ship. And they own it for $300,000, and you can buy, an apartment, a space on a cruise ship, and then you can cruise around wherever you want, stop whenever you want, pick the boat back up again, or you can rent it back out. And, they can live on a ship by buying this apartment or buying a condo on a cruise ship. And so when you begin to look at, and I think it was like $300,000 for 15 years or something like that. When you begin to do the math on that, and you think, housing is an expense and where I want to live or where I want to be and where I want to do work from. And the flexibility that we have now in moving around as a workforce or just as a society, it's not going to necessitate, planting roots very deep anymore with a house. So no. I think you're right. The rental side is where we're at. And of course, we benefit from that in storage because then when people decide to move somewhere else, they put their stuff in storage and they move. And either they come back or they rent another space in their new location and they got, multiple units. Anywhere you see multifamily or rental housing going up, you're going to see self-storage right behind it. And so, we are very keen to this phenomena that we're seeing right now.
Absolutely. I mean, I think part of it is that when, like to your point, when our parents were buying houses, you're talking $5,000, $6,000, $7,000 to buy a house. Mm-hmm. Back in the 70s, hell, even into the 80s, the houses were still fairly inexpensive compared to what they are today. I think that many people make the mistake, they do the same thing in commercial, is that there's appreciating markets and there are cash flow markets. Appreciating, cash flow, very different types of markets. Sometimes you have a mix of both, but usually there's one or the other, right? Yep. It's not like, a 0-and-1 type scenario. It's not like that. But if you're expecting to buy a house and think you're going to retire with that house, to your point, again, you're going to buy a house at a 6% interest rate or 5% or 4%, whatever it is, then you're going to maintain it. You're going to pay taxes on it. You're going to pay insurance on it. You're going to do all these things to keep it alive. And there's a reason why the bank gives you that loan, a 30-year loan. There's a reason why the bank is syndicating the deal. The bank's the one making all the money, and they lock you in for 30 years. It's for them. It's a huge. They're making a huge amount of money on that deal, and because you're only putting 3% down, you're basically over leveraged on the house if you think about it, and you can't afford to leave. And you just can't. You can't afford to leave. It really is a trap. The house is a trap. And again, I didn't even know that when I was working in corporate. I was just doing my corporate thing, and I was doing what my parents told me to do. I was doing what everybody else around me is doing, right? And clearly, what I should have been doing is move into an apartment, sock away all the money, and I should have bought like a multifamily when I was still working in corporate, or at least at a minimum, invest in one. By now I would have made so much more money at that rate, but I wasn't even thinking about that. I think part of it is that people really feel they have to feel like they own the house. Not necessary. It's not necessary.
No, it is not. It is not. Those societal norms and the conversations that we grew up with, those run deep, and it's hard for us to begin to move away or gravitate away from those thoughts until we begin to see the proof in front of us. And sometimes that's what it takes, and hopefully not too late for everyone listening out there. But let's move to one of the other topics that we were chatting about beforehand, and that is, we are in a time of change right now. You're making a shift, not necessarily a pivot, but you found what you're focusing in on right now and honing in on, which is the development side, and then triple net leases as well. And so you and I are both raising private equity, and we've seen a shift in our activity and the velocity at which we're able to raise capital and people's approach. So they're pulling out of the stock market because they don't want to invest in vapor, because it could go away overnight and it's going up and down, and putting it into hard assets and into income producing real estate, but also slower. They're holding, their cards close to the chest and kind of waiting to see what's happening. What are you seeing on your end in the private equity markets, either from, the limited partners that you're working alongside, or some of the family offices? What are some of the shifts that you notice, and, what are some of the strategies that you're trying to deploy to continue to keep that, the river of capital flowing in so that it'll fund your developments and your acquisitions?
Yeah. I mean, similar to what you're doing, we are using retail investment to get the capital needed for our deals, the equity needed for our deals. And retail means individual people out there, individual families, individual friends and family, people like that are getting into these deals alongside with us. 25, 50, 100, 200, 300K, whatever. So that's fine. And I honestly, I appreciate that people really believe in us and the team to invest, to co-invest with us in these deals. The thing is, though, as time goes on and we start getting into bigger and bigger deals, to try to continue raising capital in that manner becomes increasingly difficult. So what we're doing, and it's only because, listen, when you're doing $50 million deal, it's significant. It's a lot of equity. Right. Especially now that the lending has tightened up, and now the lenders are usually asking for they're only giving you 65% leverage in some cases, 70% leverage. That means more equity to the table. So it can be significant. But as you scale up and you start doing the, say, $100 million deals, that equity requirement becomes far, far greater too. Right. And to your point, people they're sitting on cash or hoarding cash right now. right? They're really, really nervous about what's taking place in the market. In a way, I think that, like I said earlier, you said the same thing, putting cash into hard assets that continually produce cash is really what you want. I mean, I don't want to hang on to $1 today. What for? It's worthless. It's going down in value every second, every minute. It's losing value, right? Because of the debt that we're accumulating as nationally, right? We're accumulating so much debt that it's losing its buying power. It doesn't make any sense to hang on to it. It just doesn't. But it's hard to break that. It's hard to break that habit, right? If you hoard too much cash, that's I think it's a mistake too. But regardless, we're definitely seeing a slowdown in our ability to really get our hands on cash. So it's not a testament to how that we're having issues or whatever, but more along the lines of it certainly requires a high degree more touch. And I think people are just being very selective about the deals they're jumping into.
Mm-hmm. So what is that message? Our investors are becoming more and more savvy all the time. And so we have an education arm to our businesses where we teach people how to invest actively. But now we're finding the lines becoming blurred where these passive investors, they're pretty savvy and they are actually asking they want to know more about the asset class. I mean, it's one thing, and I'm thankful, like you, and as you mentioned, people trust us, to invest their dollars alongside of us as well because of our reputation, our history, and longstanding, and performance, and or referral basis. Maybe without doing the level of due diligence that even we would expect or require of them to do as well. But now they're asking for it. They want the education side of it. And so they want to see that the numbers are going to work and just feel more comfortable before they part with those dollars. Mm-hmm. What have you done in terms of an approach to make them feel more comfortable from an education standpoint, or how are you able to combat, the nervousness in the market right now as you're, reaching out or communicating with your limited partners that have more freely invested with you in the past?
Yeah. I mean, part of it is that we do several things. We remain very, very transparent about what we're doing. I'm on the internet just about every day, putting out content. Previous to that, we're doing our podcast or show. We're always out there. So it isn't like we run and hide or whatever. Like, we're always available. My partners and I are always available, no matter what. Very, very public facing. If there's ever a question, we get on the phone, we get on an email, we answer them. So part of it is maintaining that open line of communication. That's one thing. But I think more importantly than that, though, is, it's going to sound, I don't want to sound like a jerk or anything. Don't do dumb deals. I mean, I don't know what else to say. don't do dumb deals. Meaning, the deals that we were talking in the green room, the type of deals that we're doing, I'm trying to find deals that have density, that have population density rather. There's money there. There's activity. Wherever there's activity, there's money. I'm trying to do those types of deals, right? We're doing one deal. It's a very affluent area, one of the wealthiest areas in the Cleveland metro. All the other deals that we're doing are tax advantaged. There's a 15-year tax abatement. There's opportunity zone. There's these great ways that will help shield the investor's money from these crazy taxes that, if you haven't seen your crazy taxes already, there's nothing compared to what's going to be coming up in the next 10 years to pay for what's happened over the last 2. It's coming. You need a way to shield that money. And that's why we're putting together these amazing deals that make total sense for not only today, but in the future. So we're putting together strong deals, right? And that's the only way you do it. Like, I'm not putting together deals like Airbnb. There's these guys that buy like 24 units of it's like an Airbnb play in a residential area. That's a high risk deal to me. The city can come in at any given time and say, you know what? This is zoned in multifamily. We're shutting it down. Get lost. That's it. If you're going to convert that where each unit was supposed to be paying you $3,000 and now it's only paying 15, you just cut your NOI in half, basically. Big problems, right? Big problems to cover the note there, for sure. You can't run deals like that. That doesn't make any sense to me. I would never do a deal like that. So part of it is that maintaining open transparency, mm-hmm. open lines of communication, and don't be dumb with your deals. Good, strong deals is all we do. We do not do high risk, ridiculous deals, and everything else we do on the syndication side anyway is very simple. No crazy waterfalls, none of that stuff. Very simple, easy to understand. Just to your point, partners, passive investors, the limited partners, they're savvy. They get it. And it needs to be simple and easy to understand for everybody. So everybody knows exactly where they stand, right? Mm-hmm. I'm a big believer in that. That's how I would want to do it. That's how we did it that way.
That is, as the old adage goes, a confused mind says no. And so when you begin to put together a complex deal with the complex waterfalls, when somebody can't understand how they're going to get paid, then they feel like, hey, I think I'm getting screwed here somewhere, but I'm not smart enough to figure out how yet.
Right.
And they say no. And also to your point, we see a lot of deals out there that are offering a super high pref and an IRR that is, outpacing everything else. But then when you begin to vet the sponsor and you look and to see that it's only their second deal or, the biggest one they've ever done, or maybe their first, I tend to question all of that because I think it's an apology of value and it's apology of experience. And so they have to put out some crazy numbers in hopes to attract some folks, but they really don't have the track records, and the wherewithal to be able to pull that off. And so, most investors can see behind that, but that would be an example of, a stupid deal. Don't do a stupid deal because, it looks like the returns are high, but, let's look under the hood and see what this thing looks like. And if it really is realistic, to your point, if you build in, it's risk mitigation. If you build in enough risk mitigation and downside risk mitigation into your projects by way of all these tax abatements and everything else that you just mentioned, I guess, then the folks are going to feel safe, and they want to feel safe more than they want to think that you're going to knock it out of the park and take them along for the ride with these crazy numbers. At least that's what we found. Yeah.
I mean, and again, the deals that we're doing, we underwrite very, very conservatively. We don't do any crazy type of unbelievable numbers. I know the ads that people run on Facebook. I've seen those ones that you're talking about, and those return targets make no sense to me. I don't know how they're going to do it. Yeah. Given where the price of debt is today, right. I don't want to sound like a naysayer. I just don't get it. I don't get it. If I underwrote the deal the way, and I don't want to throw stones at anybody or whatever, it's not my business to do that. But I honestly believe that if you're going to put a deal together, running this business, doing this business, whether it's self-storage, multifamily development, whatever, it's hard enough as it is. It really is. So you have to have a lot of padding, a lot of cushion in there, just in case things slide a little bit. Net lease is a little different. Net lease is a lot more predictable. Net lease is a lot more predictable. So we can usually anticipate the net lease business very, very well. But that's a whole different animal. It really is. But when it comes to the other stuff, it's like, it's got to be realistic. I'm a real firm believer in that. That's what we train anyway in our program. Yeah. I'm not all about pulling the wool over anybody's eyes, because I want to be able to sleep at night, and I'm not a spring chicken anymore. I want to be able to eventually retire and live my life knowing that I helped as many people as I can,
Well, at the end of the day, that's what it's all about. And, when you talk to the family offices and these registered investment advisors, they're not looking for the high returns anymore. The number one thing that they're looking for in a sponsor, somebody to come alongside like us and to write a big check for, is integrity. And that is a difficult piece. Certainly you could try to bring that out in your brochure, but you can't advertise. Nobody knows these investors, whether it's retail or institutional. They don't know that we have integrity until they start to deal with us, and we get 90 days, 3 years, 10 years down the road. And so that is a difficult piece for anybody to, understand. And we certainly can't sell that the only way to do that is by way of referral and longevity in the business. And so for any limited partner investors out there, potential looking to invest with anyone, just make sure you do your due diligence, get good referrals, look at the track record, see if they got any skeletons in their closet. That is the best way of going about it. Let's turn now, Agostino, to the road ahead. We do have a lot of variables coming up in the marketplace right now with interest rates and with construction costs. And we mentioned the pivots that you're taking right now. Let's look a little further down, and I'm not going to ask you to get out your crystal ball and make any projections or predictions.
I mean, I have it here if you want.
Well, that's good because mine's in the shop. I haven't got it back yet. So let's, what does the backside of this recession look like? And if you want to, do you think it's 2 to 3 years? You mentioned earlier that you feel, high interest rates are here for a while. I was just in a conversation with another gentleman about raising funds and a different way for us to do it. That he says, well, we're not in a recession yet. Are you in that camp that thinks we are? And I said, well, I say in real estate, it's maybe a little different than the rest of the economy, but either way, we're going to slow down, and we're acting as if, because we're seeing the capital markets, we're in a recession for all practical purposes and valuations in real estate.
Yeah.
So 2, 3, 4, 5 years down the road, what does the backside of this look like? Are the opportunities that you're taking on right now in anticipation of selling off again when interest rates come down and cap rates are low and the valuations are high? Are you looking more of a buy and hold, or how do you plan to exit what you're doing right now, or do you plan to exit? Are you looking to hold?
Before I go on to that answer, we are in a technical recession. I don't care what the media says. We are in a technical recession. Don't let the media tell you anything else. Not you. I know you do. I know we're in a recession. 2
quarters of negative GDP growth and the bond yield curve. We're there. I get it.
The classic definition, as it was defined for all the previous recessions, must be applicable to how it is today. If you're going to maintain a steady a steady metric across how a recession is defined. You can't change the rules of one scenario and expect it to roll backwards. It just doesn't work that way.
You can if you're heading into an election year, can't you?
Yes. Yeah. That's the only way you can. That's the only way it's done. But yeah, we are in a technical recession. But here's the thing. I know for a fact, because we're in the business of real estate, COVID money is still being distributed free of charge. Handed out. We're still writing checks overseas to the Ukraine, all this other stuff to fight these wars we're not supposed to have anything to do with, right? We're still paying for all that. Eventually, all right, and that whole strategy involves taking this reserve currency that we have and outsourcing the inflation is what we're trying to do. But eventually, when you have so much of these little pieces of paper that is pushed out, you can only offshore the inflation for so long. Eventually, those dollars are going to come back home. And when they do, someone's got to pay the bill in the form of taxes. So the reason why we got off the gold standard and got into this dollar scenario is it's really our taxes and the government's ability to increase our taxes and someone's going to keep paying the bill is what it's guaranteed by. So that's a very short economics lesson, but it's relevant to the answer here because in order to pay the bill, the interest rates must continue to be high and possibly even go higher. That's what I honestly think. I mean, in some of the interviews I've seen with, I think it's the Fed of Kansas, actually, that they're the ones that actually perform the calculations of where the economy really is. And here's an interview by the outgoing, I guess that each one of these branches have their own chair, I suppose.
I think is the reserve chairman. Yep.
She says, she goes, there's no way we can't decrease it. You just can't. We can't pay the bill, right? In a way, and she was retiring, so it doesn't really matter. Like she's not going to lie, right? So the point is that we're going to see high inflation for a long period of time, high interest rates for a very long time. I really do believe that. So the only store of value you really have at this point is real estate. We're hanging on to everything right now, and we're building. Like I said, we're sticking to the plan to continue the development path because there's a need. If the need ever dries up, we're obviously just going to put the brakes on it. But as far as we can see for the time being, all of our projects are probably between 18 to 24 months out. They're all like a very close to about the same. Like we're wrapping one up. We're for instance, we're wrapping one up. We've already broken ground on another one. This one's starting up in the next 2 to 3 months. So it's like they're all about the same play, I guess, the same time frame. We'll see how it goes for the next go around, and when it comes to net lease, the cool thing is that lenders actually compete for that kind of stuff. They still compete for that stuff because the lenders know that net lease, single tenant net lease is a great asset to own in times like this. So it makes total sense to do it. But when it comes to the multifamily stuff, we're sitting on everything. I mean, if we don't need to sell it, we don't need to refi it. We're hanging on to it. We're not touching it. We're just making them better, increase the rents, get them to cash flow, send out checks. That's about it. So that's all we can do at this point with that. And we're just sitting there and we're going to try to wait it out. If it gets better in 2 to 3 years, then great. But I honestly think that if history serves as any guide which it has, we're going to probably be in this one for a little while, because you cannot print. How much did we add? $15 trillion over the last 4 years or 3 years, and just absorb it overnight. It takes a while for that to get absorbed, and the absorption is displayed in the way of the cost of everything going up, everything, So yeah, you have to just plan accordingly. And that's why we're still heavy on real estate. I don't own any stocks. I own 0 stocks, 0 Bitcoin, any of these speculative things. I stay away from it. I just don't do it. I just go into real estate and I stay there. That's it.
Yeah. Well, we're in the same boat and of the same mind, I believe, when it comes to that. I just wondered if your crystal ball was open.
My crystal ball works. No, I'm just kidding.
Yeah. Well, Agostino, our time is up right now, but we definitely are going to have a round 2, and maybe do a little deeper dive into the macro markets, or just kind of a follow up, maybe a couple months from now, to see where we're at and look at the approach that the both of us are taking for the benefit of everybody here. So, on behalf of Storage Nation, it's been an honor and a pleasure to have you on here, Agostino. If people want to follow you a little more closely, what's the best way for them to be able to find you? Sure,
bulletproofcashflow.com. We're pretty much everywhere. We're on YouTube, LinkedIn, TikTok, we're everywhere. So go ahead, check it out.
All right. And the Bulletproof Cashflow podcast as well. So tune in, folks, and lots of good nuggets and great guests, and also more tidbits and nuggets from Agostino. So once again, my friend, so good to spend time with you, and looking forward to our next one. Take care, my friend.
Man. You bet. Thanks.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.